Hi, I'm Philip Franks. I am the founder and creator of the Franks Report, and this is my segment on Away from the Charts. This is where we talk about trading concepts for everyday retail traders and try to educate as best we can. And hopefully that'll help you out in your trading and in all your future endeavors. So, last time I talked about setting up charts, in a general manner. Today I want to talk about some techniques you can use on the charts, some technical techniques on charting. And one of the things that experienced traders always do is find the ceilings and the floors of any given index or stock or whatever security it's going to be. And these are things you need to know going into a trading session, right? This is part of your research beforehand. And if you know what the floors are, for example, and what is a floor? Floor is the bottom, the supporting floor of that given security, right? This is more or less the lowest that it's anticipated to go. It's like, and there's levels to this, right? You got your primary floor and below that. And it's the same with the ceilings, With the ceiling, it's the uppermost price action that is expected to be seen or has been seen, by a given security. So when you have that, one of the tools you can do, there are drawing tools on your charts, in case you didn't know that, fellas and gals, is that if you know that the floor is going to be some value, some price, you can actually draw on your chart and do a horizontal line. So you can actually visually see where the price is charting in relation to that floor. Also with the ceiling, you can actually draw a horizontal line to where the ceiling is anticipated to be. And you can see where price is printing in relation to the ceiling. And depending on your strategy, maybe you trade breakouts. Maybe when it breaks out of, it breaks to the bottom, that is your time to jump in, or when it busts through the ceiling. A lot of people will use these bounds to watch for inversions, when it starts trending the other way. So let's say it's dropping to the floor, but that's not the expected reality. We're actually expecting it to stay above that, but there's some kind of action, and a lot of times it's institutional traders with large orders who are pushing a given security to move it, to blow through stop loss, to create liquidity and grab money. And then all of a sudden it's going to shoot right back up. And so traders will, when they see it break through the floor, if they're expecting it to stay above that floor, they will try to capture that inversion of when it switches back. So they'll go long. Same with the ceiling. Let's say it's they're anticipating it to stay below the ceiling or maybe near the ceiling, but it just blows past it. And it may be something that's, artificial, that's happening in the market, that's moving that asset that way, but it's not expected to stay up there or continue climbing. Then they'll try to trade that that inversion back down. So then they'll go short, right? So that is how you can use those floors and ceilings to sort of track what's actually happening in the market in relation to expectations. And it helps keep you, grounded in reality and seeing what's happening so you can make the best decisions, or how, maybe this is something you need for your particular strategy. Maybe you're an inversion trader and this is how you operate. You work within those extremes and just try to ride the whole length of that inversion. So if it blew through the floor and you go long where you expect it to finally turn around and ride that all the way up, then that's what you do, and then vice versa for the other way. So that is one thing. Let's see, another thing I wanted to kind of touch on. I had to grab a notebook because my brain just wasn't quite there on some of these topics. So I just want to make sure I'm still on the right place here. Okay, so there's another concept that a lot of beginning traders don't realize, and it's understandable because you don't think about it. There's money in the market, right? There's money in the market. But here's the question: how much money is in the market in any given time, especially when you're actively trading? How much money is available? And let's say, for example, you are in a trade currently. You've placed a trade, okay? Let's say that you're long a position. All right. And you're like, I'm going to ride this out. Like you're in the green. It's gone up a little bit. And, but you're like, no, I'm going to continue to ride this. And then all of a sudden it goes down, or it tops out there, and you were waiting the whole time for it to completely keep going. That you missed out on your profits altogether. And one of the things that people don't realize is you're waiting for it to continue to go up, but what if that's as high as it's going to go? Because there's just nothing left. There's no money left for it to continue to climb. You know what I mean? Or there's no event that would make it blow up, right? You need some kind of catalyst. So let's say you're following a chart, okay? And it's going like this, and then it goes down, right? So you get this nice valley, and then it inverts and it starts going up and you go along. Well, there's this thing called fair value gap where as it's going up, this whole distance between the most top point where it inverted, where it started going down, and then when it changed from the bottom going up, that area is the money that's available, right? That's what was created. That's the liquidity that was created right there. So when the chart starts to go back up and now it's level from where it dropped off, that is a fair example of, okay, this is we know this is money that's available. Anything beyond that is going to require a catalyst of some kind, or to help drive that that long action continuously. But at least in theory, that this area there's money because there were buyers or sellers here at this point, and then it dropped off. There was selling going on, and now it's buying again up to this point. So there are traders in the middle there, and so that's why there's money there. And so you have to keep that in mind with fair value gaps, because anytime there's a peak or valley, and depending on the direction you're going, you need to be mindful of. That's just a good visual way of seeing money that's available. And if you're holding out for something that's not available, if you're thinking, oh, it's going to keep going down, and you're already at the bottom of the chart, it's, unless there's some kind of catalyst that you believe is going to push it further down, you may have maxed out on your short position, and you may want to go ahead and close that out and grab your profits, or take a partial profit before the chart changes on you, So that's an important concept, and not a lot of traders realize that's a thing, and they should, because that'll help keep you out of trouble, because you'll know that you're not wasting your time on, hoping and wishing and realizing there's just nothing there. So that's definitely something I wanted to talk about. Fair value gap is definitely a handy tool. You can mathematically or see like there's some indicators to show like, oh, okay, there's still some buying power still available. There's still some selling power still available. You can be, tracking real-time news events, things like that are, inflating or, deflating the market. It's a culmination of all of these things that go into your decision-making model when you're doing this. But when you're trying to manually trade and you're trying to spot check and see, these are good tools just to help you see if you're doing the right things, at least with best business practices. And, and again, this all goes back to manual trading. When you start getting into algorithmic trading, that is a different thing altogether. And granted, you can program those types of things, whatever your trading strategy is, if it's consistent and you do the same thing over and over again, you can make that into an algorithm, right? But that it takes a different kind of skill set to trade manually than to let the machine drive, just full autonomous or semi-autonomous, where a semi-autonomous algorithm will be like, hey, this is a buy signal, this is a sell signal. We just need you to push the button to say yes, go ahead and do it, or or execute. So just be mindful of that. Well, that's all I got for right now. Those are just some broad topics, but I think they're really important and should be explored. For those who are new to those concepts, we've been trading a while and just wasn't aware that's even a thing, or that's like, oh man, that's a great mental trick. I hope that's helpful to you, and I will see you on the next one. Remember, trading is risky, and take care. Bye-bye.